All right, what's going on, everybody? We have a topic request today that goes really to something I'm a big fan of myself, and that is win rate and risk to reward. Now, some of the dynamics change depending on what you trade, and the easiest way to point that out would be, for an example, if we're talking about selling to open a trade, like call credit spreads, put credit spreads, that sort of thing. When you sell to open something and those have an inherently high win rate or an inherently high probability of winning, then the risk to reward on those industry wide is accepted to be lower. So you'll often see people run a risk 4 to make 1, or risk 3 to make 1 when they do those kind of trades, and the industry says, "Oh yeah, no, it's okay. It's okay because you got such a high probability of winning." I'm not here to argue against the merits of that logic, just depending on what you are trading, the industry says it's okay if you're running a risk to reward that isn't as high as what we would run on something else. So, how much of a risk to reward we need should tie directly back to the probability of the trade strategy that we're trying to trade. Now that sounds really good at first glance. But how are you supposed to know the probability of every trade strategy that you're going to trade? And then whose probability are we talking about? Because I might have the same trade strategy that you have, and yet I might have a different risk to reward than, or a different, excuse me, a different win rate than you do, simply because once the strategy is designed and implemented, how we trade it could be different, right? So let me bring over the actual request. That way I can get the topic correct. Do 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 do. All right. So the first part of the request was about increasing the win rate. That is a lofty goal. How can we increase a trade's win rate? Now, that's kind of generic, right? It does matter what kind of trade you're taking, but there are still some tips and tricks that we can do to increase our win rates. It is really important to understand, however, when you're thinking about win rates, is how much your win rate will be affected because of the risk to reward that you use. It's a sneaky thing. The stock market industry on a whole says that everybody should be trying to trade like a 2 to 1 risk to reward, unless you're doing credit spreads and that sort of stuff, as I already mentioned. 2 to 1 risk to reward. That's the gold standard out there. It's pretty much what everybody accepts as the industry's norm. What they don't tell you, however, is that if you are trading anything greater than 0 or 1 to 1, you're affecting your own win rate. The higher your risk to reward in your favor, the higher your loss rate will be. That is a fact. And some of the best traders in the world have found a way to maintain a really high risk to reward and a really high win rate. It is hard to do. It's really hard to do. And the number one thing that they do to achieve that is they are very selective and very picky about the opportunities that they trade. So if things don't line up and they are not optimal conditions, they just don't trade it. Imagine that, right? It sounds lofty. What a wonderful idea. Hey, it just doesn't look good out there, so I guess I'm not going to trade today. Yeah, right. I hear that from people all the time, and then 2 hours later I see their sad post where they say I got my butt handed to me. I was out there trading this and it looked good and no, it didn't work. And yet we knew it was a high volatility, high risk environment and they did it anyways. We all do it. I'm not pointing fingers. I am not judging. Believe me, I've made all the mistakes myself, so I don't have any stones to throw. Just keep in mind that if you dial in a risk to reward to try to, improve, you will by default slowly begin to increase your loss rate. And then you will have to circle back and make deliberate strides and attempts to decrease your loss rate while maintaining that high risk to reward. Okay, so they are absolutely connected like a sliding scale. And if you adjust one, it hurts the other or it moves the other. So conditions are one of the ways that you can do this. Me, I use time a lot to validate my conditions. For an example, I don't trade between 8 and 10. I'm not saying it's untradeable, but I know looking at my track record, looking at my trades, I don't do as good between 8 and 10. My loss size is bigger. My profit size is equal to what I was getting in less violent environments. Therefore, it doesn't make sense for me to trade in those conditions. Why would I? I can just trade in other areas, make the same size profit, and when I lose, the losses are much smaller. So we have to look at everything that we can do when it comes to our trades to modify those numbers and get them into our favor as much as possible. A win rate of 1 to 1 or starting at 0, right? They both mean the same thing. If you have a risk to reward of 1 to 1, that is considered to be a fair and equal playing field. You don't have any edge, they don't have any edge, and it's a 50-50 coin toss that either side could win. You're not handicapped in any way, but neither are they. And that's 1 to 1. Anything greater than 1 to 1, if you're risking one to make two, risking one to make three, now you're applying a handicap to you. If you go the other way around, if you risk two to make one, risk three to make one, then you have a higher win rate probability. And that's fair, right? That's absolutely fair. You should have a higher win rate probability. You're risking more money for less reward. That's why I've said before, and I continue to say, the market really is a fair and balanced market. It's really fair and balanced to all playing fields. As long as you understand the rules, it's all good, right? We get out of line and we miss the rules, then, we get hurt really bad. So they want to learn, the request was learn more about increasing the win rate. That is going to be recognizing better risk opportunities. Sure, we could say it's about strategies, or we could say it's about our entries or our exits, but really it's about where are we trading and when are we trading. One area, for an example, that I would consider a low opportunity environment would be conditions that look like that right there, right? This middle chart. Let's get rid of these on the side. We'll just scrunch them up. This is not an optimal trading environment. Trading in that would be a higher risk environment. So that's really generic, but it fits the purpose for the example, right? If you want to increase your win rate, you need to make sure that you're trading in conditions that are optimal to your trading style. Scalpers could look at this and say, this is wonderful. This is great. Why would you not want to trade this? But if you're not a scalper, maybe that you don't like this. I don't like this. I don't want anything to do with it. Using the clock like I do, you could consider power hour to be a dangerous time frame to trade. If it's a big candles, that can be considered another area of high risk. If we are not against the high of the day or the low of the day, it could be considered higher risk. Higher risk doesn't mean untradeable, right? We can assess the risk and still decide if we want to go ahead and trade it or not. That's not a big deal. But at least we know before we take the trade that we are trading in a greater risk environment, right? That's all it is. As long as you understand that and you're still willing to do it, then all's good. The bad thing is a lot of traders can't tell the difference, or they can't tell until they look back and say, oh, yeah, no, I shouldn't have been trading there. That was a really bad idea. That hurt. But they couldn't see it before it happened. So if you want to increase your win rate, start looking for a way to identify good trading conditions versus not so good trading conditions. I can't tell you what good conditions are because I'm not trading your strategy. I don't know what kind of trader you are. Maybe you're a scalper, maybe you're not. Maybe, you know what I mean? You have to decide, well, what does good trading conditions mean for the kind of trades that I want to trade? Oh, that is some decent news, huh? Is that that's the playoff cups, right? What do we got here? Yeah, they were supposed to have that at the White House was supposed to have something going on today about that, or maybe it was yesterday. I don't know. Me, I don't pay any attention to sports whatsoever, so sports stuff generally just goes over my head. Let me get signed into the news here so I can see what's going on. All right, I'm in. Looks like Japan's still gonna be impactful over the near term. U.S. Vaccine Committee scrapes broad recommendations for hepatitis B shot in newborns. Newborns, really? Canada's unemployment went down. Okay, I'm not seeing anything that would shake the bed. So, yeah. All right. So, increasing the win rate, look back at your own track record. This is one of the reasons that journaling is so helpful. Where are you losing frequently? Is is your mornings good and you're giving it all back in the afternoon? Does your mornings hurt you and then you spend all afternoon making it back? Like, where's the trouble spot? Because that trouble spot very likely is your high risk zone, and you should step aside and not mess with that. If you're getting dinged all day long, well, that says there's a lot more than just the risk environment, then there's something wrong with your strategy, right? But we can also increase our win rate based on our target profit, which indirectly circles back to our risk versus reward. If we run a shorter profit target, it almost inevitably will affect the risk reward, but you will win more often. It is a fact because math is math, right? It's one of the reasons I love trading. Math is math. So if you aim for a shorter profit target, you will win more often. That's the way it works. Unfortunately, you might not win often enough. And the profit that you do win may not be enough to cover the losses when the losses do come, because there always will be losses, right? That is also inevitable. There will always be losses. It's a fact of trading. So we have to limit our losses and increase our profits as much as possible. And even if we have a 97% win rate, which is easy to do in options, I could show you how to do it in a heartbeat. But winning 97% of the time, that's not our goal. That's not even optimal, because the profits would be so small that even the 3% of the time that we're losing would wipe us out. I personally have an average win rate under 70%. It's higher than 65, it's under 70, it kind of fluctuates in that 4 point window. And if it gets above 70, I know that I'm slipping and I'm doing something wrong. Sounds funny, doesn't it? I'm winning more than 70%. I must be doing something wrong. On the other side of that, if it drops below 65, I know I'm doing something wrong. That really sharpens my attention and focuses back on what the hell am I doing? Why is this happening? It usually is a behavioral thing. I get too cocky and big headed. I get too gun shy and I'm getting out too soon, too skittish, right? There's a cause and effect to everything. But by journaling my trades, I can keep track of my own behavior and start to tell when there's warning signs. The best way to dial all of this in is one, that you trade consistently. If every single one of your trades is a different trade, then it's a nightmare to try to figure out what your strategies risk to reward is, what your goals are, what your problems are, because it's just shooting from the hip at these random odd moments all day, every day, in different conditions and different environments and different setups. So try to be concise and precise when you're journaling to say this was, a 2 bar reversal, this was yesterday's 111, whatever it is, so that you can put it in the right category. Okay, now that I've identified what my trade is, what's my stats? How often do I trade it? What's my average risk? What's my average reward? What's my average win rate? My loss rate? And we can aim for a particular risk to reward in the strategy and then get a different outcome in real life because that's the way it goes, right? I can aim for 5 and end up with 2. The market doesn't have to do what I want it to do. So when it comes to risk to reward, I like to break things down into my strategic risk to reward. What am I trying to do? And then my historic risk to reward. What did I actually do? If I don't see a path to reaching my risk reward before I take the trade, I don't take the trade because there's no room for me to get to my stat. So, for an example, we'll just zoom right back into this spot here. If I'm risking 2 to make 10 and the entire range that I want to trade is 8, then there's no room for me to risk 2 to make 10, right? If I'm going to hit my head at 8 points, then I can't make 10 points of profit in an 8-point range. Even if the range was 10 points, don't assume that you're some stock market wizard that can nail tops and bottoms and get into a 10-point range and get 10 points every time. You need at least a 15 to 20-point range to get 10 points out of it somewhere. So I like to ask that simple question: is there enough room for me to hit my profit target in the thing that I'm about to? The answer is no, then I know I shouldn't be trading that thing. Pretty simple. So if we can increase our win rate by shortening our target profit, that also means that we need to shorten our stop. But if you haven't learned yet, your stop can only get so small before you're just immediately stopping yourself out because your stop is too small. So your stop is going to dictate by default how big of a profit target you should have. How small can you actually get your stop? That should vary depending on the product that you're trading and the market conditions that you're trading. For me, I like to trade the NASDAQ in the middle of the day or the middle of the morning session, Globex. So at 4:30, 5 o'clock in the morning, when I'm trading the NASDAQ, it's not really all that violent. And I'm going for 2 for 10. It's not hard to do. Not in these conditions. I can easily risk 2 points and not stop myself out. If I try to use a 2 point stop on the NASDAQ at 9:35 or 9:40 in the morning, anybody want to guess what happens to that trade? Yeah, I get stopped out almost immediately, right? Of course I would. Try to trade the NASDAQ at 9:40 in the morning with a 2 point stop. You'll probably get stopped out pretty fast too, right? Is it guaranteed every day? No, but it happens often enough that I certainly wouldn't try it because I already know the outcome, right? The NASDAQ is a violent booger that will jump up and down multiple points per second, and my 2 point stop would just immediately get taken out. So that's a really good example of knowing the conditions for the market that I want to trade and where risk zones are, and then looking at what my goal is and realizing, no, I can't trade there. Not with that risk to reward, not with that strategy. I'll have to find something else. And of course, I can turn on Jigsaw and go to a smaller time frame and I can make it work, but it would still be a higher risk condition in a higher risk zone. So I don't bother to try to make it work. I don't need to. There's so many good spots to trade. Why do I have to struggle to trade the bad spots? Now, this person that was asking the question has almost a 1 to 3 risk to reward. And that's awesome, by the way. Anything greater than a 1 to 1 is good. Anything greater than the market standard of 2 to 1, and you're awesome right there. But what is the average loss rate for a trade strategy that's winning 1 to 3? How often do we have to win in order to not blow up the account if we're running a 1 to 3? Now, I used to have a grid with this in it, and I bet I do if I go hunting around somewhere. I bet I can find it. But let's see if the AI can answer this question for us without me getting the grid out, because I don't know exactly where I put it anyways. Sorry, I can't type and talk. I can't chew bubble gum and walk. We'll see if the AI can answer that question. The break even win rate is 25%. You have to be winning at least 25% of the time to not blow up the account. Now, I'm going to bump that up a little bit because we have commissions and that sort of stuff, right? And there's slippage when we lose. So let's just use a rounder number like 30 and say that you have to win at least 30% of the time to not blow up. All right. So you can look back at your own trade stats and start asking questions like, am I winning 30% of the time while I'm risking one to make three? And if you are, then you already know, okay, hey, at least I'm sustainable. I won't blow my account up doing this. But how can I improve it? Where were the losers? Were they, like I mentioned earlier, at the beginning of the day, near the end of the day? Were you trading in front of big events like the 8:30 job numbers or something like that? Was you trading against the highs of the day and the lows of the day? Right? Anything that we can do to identify, hey, this was a higher risk environment, and then eliminate those higher risk trades, right? That kind of makes sense. We all take risk in a way that suits us. So, by all means, I'm not saying that we can't take risk. We have to, right? We have to take risk, but it has to match your ability to manage that risk. So, look back at your trades and try to point out the ones that you could see in advance were a riskier situation for whatever reason that you deem it a riskier situation. As long as A, you can recognize what it is so that you can find it again in the future, and B, something that you can articulate or highlight or write down or in some way define so that you can make it a part of your system that says, in these conditions, whatever they may be, I need to dial it back, take less trades, avoid trades, whatever we can do. On this chat that's happening right now, um, it kind of fits into something that I've talked about in the past. Let's talk. Let's just put one of those names, SMR, on here so we can look at it. We don't need all this stuff. We just turn that stuff off. All right. So I've got, I believe, a daily and a weekly right here. Yep. So when we have a market that's falling, what they don't want to do is just crash it and burn it with big candles that scare everybody and freak them all out, right? So what they like to do while it's falling is it'll gap up and then it'll fall. And then the next day it'll gap up and then it'll fall. So that it can still get its average daily move to the downside, but it's not making the full average daily move from one candle's close to the next candle's close, because that would just be too much and it would scare everybody. But when we start turning that around and we start going up, well, we don't want stick figures all the way to the top with full average daily moves from candle close to candle close to candle close to candle close. It'd just be too much, too fast. It's unsustainable. It would outrun its moving averages and it'd fall back down again. So they gap down, open it up, and then run the full ADR, right? It allows profit taking. It stops the market from getting just too unattainable, too far, too fast. And it's a mechanic that should work as long as they're going to begin to run it back up again. We can see it happened on the way down, and now we can expect to see it happen on the run back up. It's really pretty cool, all things considered. And it matches the same thing that we've talked about when we have what I call a swing low that we expect wicks underneath. So we get the swing low, we start turning back the other way. When the new bar opens, we expect a wick and then the run. And then that candle closes and the new bar opens and we get the wick and then the run, right? Because that's what we're supposed to do. So it's cool that you've been able to identify that, and it is sustainable as long as the market continues its daily advance, closing higher than the previous day's high, and continues to drive that upward run. Once we begin going sideways or we roll over and start to go down, then look for the whole thing to flip and you'll be looking for a gap up and a move down and then a gap up and a move down, on and on and on again, right? It's pretty neat, all things considered. What's cool though is that you were able to spot it. So yeah, that is awesome. You gotta love the market, man. I tell you, it just does so many awesome things, right? Speaking of fibs, look what we bounced off of on SMR, yesterday's mid. Videos on what the way price dynamically moves higher and higher or lower and lower. Not that I know of. It's it's not anything that requires more than what I just mentioned, right? So making a video that's 2 minutes long, I haven't made one. Um, as far as I know, every single candle textbook out there covers the logic somewhere along the way, as it should, because this is what price action does, right? But all the candle books focus on the daily, the weekly, the monthly, at least all the ones I've ever read, because they're old. They weren't written in this modern world where we can see, 15-minute, 5-minute, 30-second charts. I have never read a modern day candle book. So you could certainly try, try one of those books and see if they bring this context to life. I just haven't. Now that I do get. Um, I had a client a couple of years back. He was not journaling his trades and he wouldn't share his trades with me. So I couldn't see what he was doing, but he had a very high loss rate. And he started to really get upset. And he said, I cannot win a trade. I said, okay, well, no exaggerating. What's your win rate? And he said, zero, 100% loss. Every single trade I take is a loser. And I said, well, it's impossible to lose every single trade. Even on accident, you're going to win one once in a while. Like, oops, I won one. You're going to break the rhythm. And he said, no, I'm losing every single trade. Well, he finally started to journal his trades and he took some pictures and he showed them to me. And it turned out he was reading everything backwards. Dyslexia exists in technical analysis. I didn't know that. I had no clue that you could get dyslexia in candle analysis and literally read everything backwards. But that's what he was doing. That is why he was losing 100% of the time because he was taking the perfect trade completely backwards. So he was taking every wrong decision. So when it comes to trying to solve the problem of why in the hell can I just not get on the right side of the market, you have to really start showing what are you doing so that we got a better idea of what the hell are you doing because it's nearly impossible to lose 100% of the time without effort. I mean, I could do it. Trust me. If I want to lose 99, 100% of the time, I can make it happen, but you can't do it on accident. Mm-mm. Something's wrong. So, a very clear picture with lines, that said I got in here and I got out there. And you know what I mean? Like, I had someone send me a picture yesterday and it was just 3 bars. And this is a daily, so I guess it'll be perfect. They sent me a picture and it said, I got in here and I got out there. Do you think that was a good trade? I don't know. What was it doing in between there? This is a daily chart. What were you doing? So if you do take pictures and you go to submit them just so we can see what you're doing, make sure there's enough there that we can, identify what you're doing. If it was a day trade, have a little bit of yesterday's price on the picture so we can see, was today's price inside of yesterday's price? Was it inside of the Globex range? You know what I mean? Like, because we'll figure it out. If you're losing that much, something is wrong. Maybe you're reading it backwards and dyslexic. Maybe you're taking the highest risk trades out there. And of course, those are unsustainable. I don't know. But having a really high loss rate is very unusual. It's very unusual to have a very high loss rate. So um, you should want to get answers as soon as possible. And if you haven't been documenting your trades all through this journey, start now. Because if you want to continue to grow as a trader and to be here going forward, it's the only way you're going to survive. Without documentation, how do you improve? Which, by the way, improvement doesn't come from trading. You cannot trade your way to success, whether in paper or live. The only way to improve as a trader is through education, not from pulling the trigger. I'm a very big believer in this. So, what have you been doing to improve as a trader? What book are you currently reading? What topic are you currently studying? And how are you studying it? Right? I was talking to somebody the other day. He said, well, I turn on the video and I kind of listen to it while I'm messing with my charts. I'm setting up my indicators. I'm doing this, doing that. So you're not actually sitting there watching the video. He said, no, no, I'm listening though. Yeah, no, that trash don't work. Shut everything off except watching that video. Get a notepad and pen or, you know, a text document right underneath it. Pause the video to take notes and capture screenshot images. Document what you're doing. Education and learning just like you're in school, so that when you're done, you could take a quiz on that darn thing and be able to answer questions, and you can adapt it and grow with it and bring it in and make it a part of your system. It is easy to get distracted nowadays. Even me, that's why I turn everything off when I'm watching a video. And I like Discord for that. I can stick a video in Discord, and then underneath the video, I can write and take notes. And that way, the only thing that I have on is that video and Discord, and I'm putting the notes right there in the Discord while I'm doing it. It's fantastic. Dude, they have been so good. Me and my wife have been watching those too. Some of those bombs were big. On the screen right now is one of my Discords, and this is a great example of when I was learning about the jade lizard. I went out and I got the video, I threw it in the Discord, and as I watched the video, I would pause it, take notes, and I've got a channel that is nothing but videos because I just went out and like captured a ton of videos and brought them in here so that when I was ready, I could just copy the link one at a time, migrate those videos over to the appropriate channel, and watch the new video and write notes for that video and then move it into the next category. Like, people laugh when I say I spent months learning moving averages. And I had someone really sassy say, "Wow, it took you months." I learned moving averages in 2 hours. Okay, well, maybe I'm just stupid. Maybe it takes me a little bit of time. I spent months, 8-hour days, months learning moving averages. So, how many 8-hour days have you spent looking at VWAP and studying VWAP or yesterday's high, yesterday's low, yesterday's close? Because I spent weeks of 8-hour days studying each one of those pivot points, MACD and stochastics, which I don't use now, but I didn't know I was not going to use them when I studied them. I spent months on those. It's not like we can just watch one video about a floor pivot and suddenly, we're a floor pivot master and we can go out and use a floor pivot. Trading is depth, and we have to understand the concepts. So the more work we can put into it to reach that understanding, the better. Journal your trades so that you can, one, see what you're doing right or wrong, but two, you can ask others for help because we are more than happy to help. I'll speak for myself. I'm more than happy to help. But if I can't see what you're doing, I can't see what's going wrong, and then I don't know how to fix it. I'm in a lot of different places, and I've seen an area there recently had a influx of new traders. And I said to someone, "Look, man, you're new. It's so obvious you're new. Don't trade anything this week and next week. We got FOMC. We got this indecision with the rates. There's all kinds of high risk right now." And the person can't trade options either. They're just trading stocks, which means they can't protect those stock trades. And they're like, "I'm not new. I've been trading for a year." All right. I mean, maybe you've been doing it for 5 years. You obviously still don't know what the hell you're doing, no matter how much time you've been doing it. And the guy is dangerous to his own portfolio. All I wanted to try to get him to do was just slow down and breathe. And he was not willing to slow down and breathe whatsoever. He just, what's the next trade? Oh, we went down yesterday. Where was that dip yesterday? We dipped yesterday and it was 500 questions all at once. Is this buy the dip mode? What are we buying? Where do I spend money? Can we get this? What do we do with it? Where's the entry? Where are we going long? Let's go. Where? Can you imagine? The guy has no clue. He was just so anxious to get into something. And he's not going to listen to anybody because it's not an education community or anything like that. He's just going to blow his account up, unfortunately, and that is really sad because he doesn't have to. But go over to like FX Street. They have a Discord, or like TrendSpider. TrendSpider's not as bad because they teach over there, but FX Street, oh man, you can just see the train wrecks unfolding. It's like watching a NASCAR wreck. All right, so amen to that. Yeah, I can't disagree with that at all. One thing I like about trading is it doesn't matter who you are. I worked for people that were 18 years old and I was twice their age and they were my boss because their daddy owned the place. You know how that really sucks? I get a little salty about that. Some little nothing telling me what to do. Doesn't even know what my job is, but he's the boss. He's going to tell me what to do. In trading, nobody cares what your name is, how much money you have, who's your family. It only matters that you've learned enough to be able to do the thing. So that's one thing I really like about the market is you have to earn it. So we've talked about how we can look at our win rate in relation to our risk to reward. I did ask AI how much I need to win if I'm going to run a 1 to 3 risk reward. I know I built a spreadsheet for this. I'll find it, I'll dig it out, I'll put it in the chat. But until I do, you can ask AI, hey, if I'm running a 1 to 1 or 1 to 2, 1 to 3, what's my risk to reward or what's my target win rate? What do I have to survive? And AI will be able to tell you that. So 1 to 3, it said 25%. I'm going to say 30% just to cover commissions and slippage and whatever. You need a 30% win rate to survive, or you're not going to make it. So then, if the win rate is bad, you have to document what is up with my uh, win rate. Where am I losing? And be able to articulate or define what kind of losers are you getting? Are they reversals or continuations? Are they, in the morning time, in the afternoon, in pre-market or at the open? Try to define them by some sort of qualification. For me, I qualify a lot of things by time. So is it Globex? Is it, 8 to 10, power hour, lunchtime? Those are my words because it's my language that I use for my qualifications, but you use what suits you. If you have different language or different classifications for your time frames, then do that. Where are your losses happening? Against the edges, in the middle of a range? And can you quantify your higher risk trades than your lower risk trades? Because that'll help. Stop taking the riskier trades. I know how simple and glib that sounds. Oh, yeah, no kidding. I should stop taking the risky stuff. I'm not trying to be glib. I'm just straight up honest. There are riskier trades. And if you don't do the risky ones, you won't lose as often. But we can't always tell what's risky. You are 100% right, because Babe Ruth, the most famous, right, for hitting home runs, had a really, really horrible strikeout rate. But oh boy, if he did hit that ball, it was a home run, baby. It does go back to what I said earlier, that if you want to win more often, shorten your target profit. That's Trade Logic 101. You can have a much higher win rate if you get the hell out a lot faster. The problem is, are you making enough money so that when you do lose, you can cover the losses and still have money left over? Right. And that goes back into, well, what's my strategy and blah, blah, blah. Because we can all just win a lot if we, get out at 1 point profit, 2 point profit, whatever. The problem is we have to make sure that it covers the losers. So yes, aiming for 100 points of profit is going to mean that you lose more often. Aiming for 2 points of profit means you're going to win more often. There has to be a middle ground between 2 points and 100 points, but you get the idea. And then learning to stay in longer does help. It really does. But that's an exercise very much to learning how to run a marathon. You don't just step out the door and run 20 miles. You got to run, 20 steps, 20 blocks, 2 miles, whatever. You got to work your way into it. So learning to hold to stay in longer is an art if you even want to. I don't. I have absolutely no interest in taking 100-point trades. I don't even try to make 100-point trades. I don't want to. On the screen right now, I highlighted a spot. I'm reading through this topic request for the day, and it said, I seem to have a good risk to reward, almost 3 to 1. Most of the time, my trade is the right idea. I get stopped out. Look, you guys, you got to be able to realize that you need to defend a trade. Now, I know there's a lot of books that say don't move your stop, let the trade play out. If you move your stop, you're just going to get cut away and then it's going to run without you and you're getting yourself out and blah, blah, blah. But if the trade isn't working, GTFO, right? So, what I highlighted here, what I demonstrated is this is a pre consolidation breakout trade that Grimes talks about. I love this trade. I like it, but it doesn't always work. So if we had a big bar push and then we get that little bit of a rope a dope right there, that next bar is the entry trigger. So the trade starts to move. We break out of the previous bar's high. It's on the run. And then what? Oh my gosh, it starts to roll over. If your stop is down here along these lows, say under that candle that you entered on, and the trade starts to work and you've got a target profit up here at the cog line 68.92, it starts to work and then oh no, it's starting to roll over and you sit on your hands while this rolls over and comes down and stops you out. Therein lies the problem. Why did you not get out? When I ask people that question, they say, well, how many times I've gotten out and then it ran away without me and made money? Oh, yeah, I do know because it happens to me all the time. I get out, it runs anyways, it goes to my target, and it did it without me because I wasn't in it. Damn it, I hate that. But you know what I hate worse? Losing money. The psychology books say that humans on average would much rather lose money than miss the opportunity to have made money. Now, think about that because all of us are affected by this logic. What makes you more salty that you watch a trade happen and you weren't in it, or that you at least tried and well, if it didn't work and you lost, well, okay, you didn't work and you lost. And you absolutely could get back in. 100% yes. Yes, 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 because you got choices, right? You got choices because you still have money to make those choices. But if you had gotten stopped out and you lose, now you don't have the money to make that choice. You can get back in, you can find another spot later, you can do so many other things because you survived to trade another trade. But if you just sit on your hands and watch it come down and take you out, now you're down money and you're going to have to worry about, well, how am I going to replace that money? So when I look at this and I think about risk to reward, the other part of this that got my attention is I get stopped out, right? My trade is the right idea, but I get stopped out. So here's the problem with risk to reward. And I mentioned it earlier. How big is your stop? Because it is going to affect your profit target. If you are not really good at entries and you don't have any sort of order flow in your background, you may need a big stop, 5 points, 10 points, 15 points. And depending on who I talk to, they'll say, oh, yeah, I'm using a 15-point stop, but that's not very big to them, right? That's their words, not mine. So if I need a 15-point stop and I'm running 3 to 1, I need a 45-point profit target. Come on, man. That's unrealistic expectations right there. 45-point profit targets. But hey, I got a really high risk to reward, a worthless risk to reward, in my opinion, because you can't consistently hit 45 points of profit. And therefore, you're losing 15 points and not able to make up the difference because you can't hit the winners. So, the solution to this problem for this particular question is get rid of the 1 to 3 and instead go back to the industry's standard of 1 to 2 and evaluate how big that stop is. Is your stop bigger than the size of the average candle? How do I answer that question? Bring up the thing that you want to trade and apply an indicator. I know everybody thinks I hate indicators, but I don't. It's called the ATR indicator. This is the average true range, and it's going to tell us the size of the average candle. Marziti, I hope you have a really great weekend, buddy. Always appreciate when you stop in. You always bring something to the table. Maybe you'll get some of that mudding done since you're jumping out of here early. So now that you've applied the ATR, we got to adjust the settings. We want to know what one single candle is, right? So dial that thing down to a 1. You could use 2 if you want to, just because on some platforms, 1 might break it and then it won't work good at all. So if you do put it on 1 and it disappears or it doesn't work, move it up to 2, right? That's all you got to do to fix that problem. So 1 or 2. I know Thinkorswim can do 1, so I'm going to put it on 1. And now what it's doing is it's looking back at one single candle and it's showing us the average of those one single candles. And it's telling us what the ATR is. Right now, it's less than 3. So if my stop is 5 points, then my stop is bigger than the average range of the bars that I'm trading. That's not good, right? It's not impossible. I can still trade, but I know now that I'm at a bit of a handicap. If I was trading in the higher ATR area of the day when it was at 8 or 10 or 12 points, and I was using something like a 3 or a 5, then I'm doing better than the average true range. That's cool, right? So look at what the size of your stop is and look at the market you're trading and ask, does my stop fit this market environment? It would be better if our stop can avoid the candle sizes. If the ATR is 2, then I need to stop, let's say 3.5 for this 275. That would give me 3 ticks of leeway outside of the average bar to not get wicked out. Right? I can use a 3.5 point stop and a 2.75 ATR. If we round up and say that this is a 3 ATR, then I need like a 3.5 or a 4 stop size. Get my stop farther away than the distance of an average candle. 2, I was talking to someone the other day about getting actually physically stopped out. I do not get physically stopped out very often anymore. I had to look back in my journal for like, when's the last time I got really stopped out, full stop, slapped on the face? It was a while. And it was one of those gotcha moves. Oh, I mean, you know what I'm talking about, where the candle just dumps on your head for no reason in the blink of an eye. It was one of those. Otherwise, I very rarely get just gut punched, stopped the heck out. The reason for that is if you're running one contract, sure, why not? Let it wobble and jiggle around. It's okay. Maybe you're going to get stopped out. If you're running 8, 12, 15 contracts, you don't want a full stop. You really don't want a full stop. So I don't let it come back and get underneath my entry and then come back and give me a full stop. It hurts. It's too much. So I tend to defend my trade. If you're taking a full stop, really evaluate the trade that you took and ask yourself, did I have a chance to defend that trade before the full stop happened? Because believe me, I understand completely if you pull the trigger and it dumps on your head. That happens, but there's nothing any of us can do about it when it does. But it shouldn't happen every single time you pull the trigger. So how is your stops getting hit frequently enough that it's affecting your win rate? And the only answer that I can come up with is, are you sitting there watching it roll over and fall and fall and fall and then whack you out? Why didn't you defend and get out? So I don't know, right? But that would be another piece to this is learn to defend. And yes, it absolutely does suck if you get out thinking it's going to come down and get you and it runs away without you. It absolutely sucks. But in my opinion, missing money is preferred to losing money, and I would rather miss than lose. That's me. Everybody has to make this decision for themselves, but that's the way I go. The next part of this question, what's up? No, it's perfect. I'll use the same area that I used earlier. This is Adam Grimes pre-consolidation breakout, that little scenario right there. And so when the red bar closed in that little loop-a-doop maneuver, in the very next bar, oftentimes, if I'm looking for a little bit of a scalp, I'll trade that. So the new bar opens. I'm looking for a wick. Let's say I get in just above the entry or just above the open of that bar. So that little dot is my entry. Might be hard to see on the screen. If it is, let me know. I'll make the dot bigger. So that's where I'm at. And I'll put my stop underneath the low of that bar. And we'll just carry that stop across. So price runs up, it breaks the range, it's on the run, it closes near the highs, everything is going great, it looks beautiful. Then it gaps up from this close to that open is a gap up. It's minor, but it's there. It gaps up, and with no wick on the top whatsoever, it immediately starts to fall. As soon as it crosses through the close of that bar, I would start getting nervous. Now, that doesn't mean I'm going to immediately just get out of the trade, but it crossed the close and now I'm on alert. Then it crosses the midpoint of that bar. I am exiting some of my position at that point. I wouldn't even be in there in the full position anymore because it crossed through the midpoint of the last bar that was closed, profitable. Right. So I'm getting half of my position out right there on that cyan line, not to the tick because I don't sit there and measure them like that when the trade is live, but I would be aiming to get out of half at least, if not more. When it closed, when it got through the open of that bar, I would be closing almost the entire position at that point. And if I had anything left on at all, it would be a runner, and that runner would be sitting right in front of my original entry. My stop that was down here would have been gone at this point, and my GTFO last exit would be right on top of that entry, so that at no point could I take a loss. That is defending the trade to me. Yeah, trading with more than one is awesome, huh? Another really good thing about runners, I'll show it here going the other direction. Say I was looking at all of this and I thought, oh man, that looks like a really great short. Let's see if we get a pop and drop. Sure enough, it pops up, it starts to roll over, and we get short as it crosses through the half. And we put our stop up here. Now we're doing good. It breaks the low and closes below that low. And on the new bars open, we get in with another contract as it crosses through the close. Now we're in with two, and our average is going to be like somewhere right in here now. So now we're in with two contracts. It comes down, and on the way back up, it comes back farther than we like, and we close one out. Now we're still in with one, and it's right there. So that's our new position is at that point because first in, first out. So we got out of that one, but we're still in with this one. The new candle opens and it immediately starts working in our favor. And as it crosses through the low of the last bar, we get in with another contract. That, of course, brings our average down, but we're in with two again. And I've done those kind of trades, not really a lot lately, but getting in, getting out, getting in, getting out, adjusting to what price is doing while I'm running it. I'm a big fan of that. And if you notice, you stay in the whole run. The only thing you're doing is going from 3 to 2 or from 2 to 1, but you stay in the whole run. And I liked it. I don't really have a problem with it. It's just that it seems like more often lately I go ahead and I get mine and then I just stop. But yeah, I like doing that. If you can run more than one contract, being flexible to get in and out and then back in again and out, that's really nice. I get that. You want to be careful when you go to add a trade contract when you're already down. We can call it averaging in or whatever. I don't really like to use that phrase, but averaging in, whether that's what we really did or not, it's dangerous. Oh yeah, I've made all kinds of mistakes. I've made the mistakes that everybody. Hold on, I just the I I don't recommend getting out at break even. If you averaged in and then it finally starts to turn and it starts going your way, getting out at break even says you took all that extra risk and have absolutely nothing to show for it. So even just one tick Even just one tick would be better than break even. Yeah. So manually trailing a stop is one thing. Using the auto trail stop feature is a completely different thing. In my opinion, the auto trail stop feature is trash and should be avoided at all costs. I really think it was created because two engineers said, "Do you think it's possible that we could create a way that the stop follows price?" And the other one said, "I bet you can't. You should try it and see if you can." And so they did it, but it's not a good way to try to trade. I've tried to use the trailing stop, auto trailing stop on Trade and Ninja and TradingView. I've tried it everywhere that it offers it. It's an unsustainable market practice. Now, if you're swing trading, there is a purpose for it, I suppose. But stops on a swing trade kind of suck because stops won't trigger after hours. It won't trigger pre market. It won't trigger if it was jumped over. Like, there's so many things that a stop won't do if you're swinging. So if you're swing trading, I wouldn't bother with it anyways. But at the bare minimum, I mean, it would be better than, say, going on vacation and not putting a stop on, even if it's a trailing stop. So if we are going to trail our stop manually, how should we do it? When it comes to that, there's a couple of tips and tricks. Nothing's perfect. I've got a good technique that I personally use, and it's where I use the previous bar. So, if you're swing trading, this would be pretty easy to do because, you're looking at the previous day's bar and the previous day's midpoint of the bar. As an intraday trader, it can get a little bit more tricky. But let's say I get long while we were inside of this right there. So the blue bar closes, the red one opens, I get long, my stop gets underneath the last bar. Now we're going. What's up with the stop? What I like to do is trail one candle behind with my stop. So what that would mean is while this green bar is live and active, my stop hasn't moved. But once that bar closes and the new bar opens, my stop gets a new location and it's this bar. Once this bar closes, my stop gets the new location. Once that bar closes, my stop gets a new location. And I like running it that way. That works well until you start to get big blowout bars like that. Now, my rules say if we get a much bigger bar than normal, that I do not stay the one candle away. Instead, I'll run right up to the big bar and I'll set my stop at the low of that bar, and if it closes above 50%, when the next candle runs higher than that 50%, I'll bring my stop up to the 50% of the big bar. That solves the problem of what happens when we get big bars. It's still not perfect, but it makes sure that I'm not giving away too much of the gains by letting price come back down. Even with this dynamic stop, which is what I would consider this tactic to be, I am much more inclined to force price to take me out or move in the direction that I want it to rather than sit on my hands and let it come back down and stop me out. So, for an example, in this same trade, if we were still in it and it runs up and it gets here and it starts to roll over, once it broke that low and continued to the downside, I would be bringing my stop up inside this range, inside this whole area, and I would force it to turn around and continue to move or take me out. And that way I end up getting stopped out right in that area rather than somewhere back at one of these other bars. I don't mind forcing price to either get up and go or get me out. Now, if you're running something like SPX, that option, the options on the SPX Oh boy, they're mean. They're very violent. The SPX has the most extreme change in options price out of any options contract that exists, right? So it's the rate of change in the price of the option. These things can go from 10 cents to $10 so crazy fast. If you're trading the SPX, you're going to have a system just for this. But for anything else, what we were just talking about should work. Yeah. What have you been using before now? Yeah. Yeah, you're on the right track 100%. I don't like it automatic. I like to do it manually myself. The automatic feature invariably will get me out at the worst spot. It just seemed like it had magic fingers or something because it would always be the worst spot. I'm like, why did you get me out there? That sucked. So I just do it manually, and I find that I'm much more happy with the outcome when I do it myself. A trick with options, though, that I find is really fun. You can't do it with a cash account, but say you you buy a spy call on this 5 minute open range breakout, and it runs up, and then it starts this consolidation process at 688, and you get a lot of tells, and you're like, "Yup, that's it." Now you could get out of your call, you could, but you're already up a long ways. So one thing that you could do is you could sell a call right up there. And depending on which call you sell, you now have a call credit spread or you have a call debit spread. But the call that you sell, one, should be worth more money than the one you bought at the time you bought it. And that will give you a risk free trade and give you a chance to stay in case that isn't the high. So if the call you bought, for an example, was $1 and now you're long and it runs up and it's worth, oh, I don't know, $2.50 after that run up. If you can sell a call up here for like $1.50, then you're guaranteed that this trade will make you at least 50 cents because the call you sold is 50 cents more than the call that you bought, which covers all of that cost. 100% that cost is done, and you have an additional 50 cents. So then, if it keeps running and this is a call debit, you're good. You can stay in, you'll make more money. If it's not a call debit, say it's a call credit, and we begin to fall, the one that you sold, it gets to maximize its gains. You still have to do something with this one, though. Um, if you think it's going to fall and you're going to turn it into a call credit spread, it'd be good to roll this one up so that you can maximize the profit that's in it. we said it was worth 250. If you rolled it up, you could get, say, a dollar, dollar and a quarter out of that. That's getting, quote, risk out of the trade. That's what we call it. So now it's 688. You sell a 689. Now you've got a call credit spread, or I should say you sell a 687. But yeah, you sell the other side. So now you've got the credit from the one and you've got the profit from the other and the spread between those two. And then you run it back the other direction. On Thinkorswim, if you already have a trade on, it'll have a little flag there, and you can right click on the flag and the menu will pop up and it'll ask, what do you want to do? And roll is in there. So that's the roll part. But if you don't want to roll and you just want to sell a call against the call you own, start with where your call is located. Let's bring up SPY. If I have 688, no, excuse me, 685 long and price runs up to 688, and now I want to make a call debit spread, anything that I sell that is farther away from 685 would give me a call debit spread. If I want to get a call credit spread, then I need to sell something that is the other direction. The easiest way to remember that is if you're making a credit spread, the call that you sell typically would be more expensive than the one that you bought. But if you're making a debit spread, the one that you sell should be cheaper than what you bought. It won't be in this scenario. That's why we're doing it. But if we were just starting one from scratch, which learning how to do it from scratch will definitely make it easier to do it when you're quote legging into one. So here's how we start a debit spread from credit spread from scratch. If I sell that and I buy this, the one that I bought was way cheaper than the one that I sold, and I end up with a credit. That's why we call it a credit spread. I sold something worth 25 cents and I bought something worth 5 cents, and that's why there's a credit. If we do it the other way around, if I buy the expensive one and I sell the cheap one, I still have a debit left to pay. That's why we call that one a debit spread. So once you get in the habit of doing that, when the time comes to actually put on a legged in credit, you'll have the dynamics already figured out that, well, I sold that to start. Well, excuse me, we're starting with buys. I bought that to start. If I now want to build a credit spread, I would need to sell one on this side so that I can make a credit spread. If I want a debit spread, I need to sell something on that side. We're using 685 still for our example. And I just went out a little further just so that there's more price here to deal with. So if I bought the 685 and I want a credit spread, I could sell 684, 683, 682. Any of those would be better to sell to have a credit spread. But for our purposes, if the market ran up, then our 685 would be deep in the money. So what we could do for a really good example is let's use 680, which is already deep in the money. Let's say at the time, though, it wasn't deep in the money. It was the money. So we got in it, and then the SPY ran 5 points, and now we're in the hole that much. Not in the hole, but we're in the money that much. And we want to add a short leg to this. We would then go in and we would sell the 685. This gives us a call debit spread held as a credit. The idea would be that the one that we sold that was now 685 at the money, it's probably worth more than what our 680 was when it was at the money. It's swelled up and now it's worth 625, but it wasn't worth that at the time. It was worth a lot less when we got in. Yeah, absolutely. To help with this logic, I use something called strike price shift differential to ask a question: what would my trade be worth if SPY moves $1, $2, $3, $5? And this is a really good way for me to try to gauge my risk versus my reward and how much money I could potentially make. So in this scenario, if we got into 680 when it was at the money, how much was it worth at the time? It was worth around $2.20. So when SPY moved $5, what we bought for 220 is now worth 630. We made about $410 in that move. Not bad at all. So that's called strike price shift differential. If I go to buy a call and I want to know how much of a move do I need to see for this call to double in price, if I bought the call at the money and it's worth 213 and I want it to double, it needs to be, let's say, from 220 to 440. How far does SPY need to move? 1 point, 2 point, 3 points. SPY needs a $3 move for my call to be worth 440. Is it possible for SPY to move $3 and for me to make 100% profit for my 220 call to become worth 440? I can then go to the charts and try to figure that out. But if I don't see a path for SPY to make a $3 move, then I know I shouldn't be aiming for 100% profit. I need to dial my profit target back. Strike price shift differential, it's what that's called. It's a real fancy phrase. Even if we traded a $1 move, what's the risk to reward for a $1 move in SPY at the moment? It's better than 1 to 1, but not much. I could buy it for 157, and if I'm wrong, I lose 50 cents. But if I buy it at 157 and I'm right, I'll make 60 something cents. Well, that's not bad. If I'm wrong, I lose 50. If I'm right, I make 60 ish. So, ballpark, it's a little better than 1 to 1 because we can see the loss and the profit. Right. Just for our example, right? At the time, what was 680 worth when SPY was at 680? Because we're at 685 now. What was SPY worth, or what was that 680 worth when SPY was at 680? It was around $2.20. That's what it was worth at the time. But we ran up $5 and now 680 is worth $6.25. So if we was to buy a call now at 685 and we ask how much would this call be worth if we did move $5, it would be worth 629. We can see we'd make about $4 in a $5 move. That's not bad. It is easy, isn't it? Correct. Yep. I was talking to an experienced trader yesterday who was giving me an earful about why he needed this spot gamma options evaluation tool. And I said, I've got it. I've got the spot gamma tool, but you don't need to spend all that money just to get that tool. And he was trying to explain to me that he uses Thinkorswim and he can't evaluate the options price theoretically, what it would be worth if it makes a blah blah blah. And I said, I demonstrated what we just did here, and he was stunned into silence. Like, I don't know, you're spending $300 a month for a spot gamma tool to evaluate what the option would be worth if, and I can do it in 5 seconds off of a napkin, just at a glance. So, you know, You do you is what I say. If he wants to do it the way he wants to do it, that's fine. But this is Spot Gamma, and they have this new little options calculator, and it looks very pretty. To have the green and the red and what it's worth, and it has your gamma levels and your call walls, and sure, it's pretty, but you don't need this sophisticated system. You can just look up and down the chain and be ready to go in 4 or 5 seconds rather than trying to put your stock on here, find the right strike, fiddle with all the buttons, change the expiration, do everything you got to do to see what it would be worth if we're traders. We ain't got time for this. We got to get in there before price moves. I've got a couple of how to videos when it comes to day trading options that I've shared in the chat before. Um, options Day trading options tips 101, 1, 2, and 3. I could say just scroll back and find them, but it would honestly be easier on everybody if I just shared the link in the chat. These 3 videos cover what I just did and a few other little tips and tricks for day trading options that I found very useful over the years to make our lives a lot easier, to be more profitable and keep those profits and be less likely to give them away. They're not very long videos. I tried to keep them short and sweet, hitting just that particular topic that needed to be covered. There was a question in the chat about what's the best way to tell when to risk and when to cut. And that is a really great question. Yes, some of it is experience, that's true. Yes. But a lot of times the answer should be in what price is doing, right? Like I've got these tells that I like to use because I'm an open, high, low, close, pivot point kind of person. So I tend to use those same dynamics when I trade. If I get in and price breaks above my entry candle's high and continues to go up, it's not allowed to come back inside my entry candle, right? Because I'm a day trader, that's what I'm focused on. So when to risk and when to run. I don't ever sit back and let price come back through my entry and move towards my stop. I never do that. So I don't have an answer for should I let it do it at some point from time to time? You could. I will not. I refuse to. As for the idea of, well, it ran up a little bit and now it's coming back, it's not at my stop. I'm not at risk. Heck, it's not even back to where I got in yet. Should I still stay in? That's a trickier one to answer because we don't always know, right? If it's not threatening our stop or at least threatening our entry, in theory, we should be allowed to let it run and see what it can do, and we're not really a danger. But are there any warning signs that are telling you you should cut? Is the flow changing? Was there a headline, a new hour, a new half hour? Because new hours and new half hours are dangerous. Um, is there a shift in the tick if you're watching the tick? You know what I mean? Is there any warning sign at all that you're seeing? And is price doing something different? Did it open and not continue in the same direction that it had been moving? Did it hit a measured move, a trend line, a fib line, anything? Because all of those will help better answer the question of should I continue to risk it or should I cut it? And then how long has it been moving in the direction that it is moving? What the 5 bar rule is a real thing. If it's bar 9, 10, 12, 15, and it's still the same color, you should be ready for it to turn around and go back the other way, right? You probably want to get that out, cut that one. So it's not perfect, but whether or not you should continue to risk or cut, it should be something on the chart that you can point to. Otherwise, when you get out and you go to journal, how exactly do you answer the question of why did I get out? If the answer is, well, I got scared, we continued to move in the same direction for a while, and I just felt like it needed to reverse at some point. I don't see a reversal, but I got scared and I got out. Well, that's not a very good journal entry. We got to do better than that. But if we can point to something on the chart and say, I saw this and I seen the ticks move and the order flow changed, and that made me think we were just about done. I went ahead and I got out, I defended it, and then it ran away without me. Hey, you did what you could do. You followed the rules. You spotted risk and took money off the table to avoid losing it. If it ran away without you, at least you did what you were supposed to do. I can I cannot remember the last time I didn't defend a trade because I thought that it was better to me to be right than to get out. And that's really to me what it seems like the it all boils down to is if I don't defend it, then I'm thinking to myself, I know I'm right. I'm going to hold it against all odds and every signal telling me that I'm wrong. I know I'm right. I'm going to hold it. I just don't do that. I go ahead and defend and get out. It is true that that I can remember my own journey, and I found it hard when I was newer to change my bias from long to short. If that's what we're considering pivot, I had a hard time doing that when I was new. But I find it really easy now to change my directional bias based on what the market is giving me and what I'm looking at. Well, when I go and look at Nvidia, I start with any equity. I like to start at the higher time frames. So I'm on the monthly and nothing is broke. It's still good. We're solid. We finally had a decent pullback after we got it back above 100 on that reversal and the big gap up. It's just such a beautiful move, that 3 bar reversal there. Nice run up, good consolidation. The next expansion was perfect. It's behaving exactly like it's supposed to. Everything is fine. And now we've OCC'd and we're pulling back. So that candle closed. It gives me permission to move my fibs up. This gets me a little nervous because we're below the 786 and we shouldn't be, but we're still inside the candle that broke the 786. So unless we get outside of last month's candle to the downside, then I can't see a short here because the 786 isn't a magic wand and I can't expect price to just bounce off it and go. We broke it, closed under it, but we're still inside that bar. If we break that bar, I want to take Nvidia to 150. And if we break 150, then we'll find lower levels from there. But if we're inside this bar and we continue to not break down, we got to look for the next leg up. And to me, that would be the midpoint of the monthly bar. That'd be that 190 level. Back above 190, we can run back to all-time highs. And all of that is just from the monthly. And those are way too big to deal with. So we'd want to dial that into a weekly. Then, of course, we can see that we're still inside of last week's range. And the inside breakout failed, which is not good. But OCR says we've got a higher low and a higher high, even if we are inside of last week's range. And the close this week is higher than the close of last week. Higher high, higher low, higher close. That's an indecision reversal opportunity right there. And it says don't count your chickens before they're hatched. The short is not necessarily a good idea here because we were able to turn that around and reverse it. The real mid is 190. That's a number we already discussed. But if we tighten everything up, the mid is 194 and a half. And I like that. So if we can get through 786, we can run for the half. But if we fail, and that's what we bumped our head on with this week's bar, if we fail to get above 786, we're going to break below 100, and that's going to give us a run to the downside. My system is really cool because it works on everything on any time frame. It's really neat. It's just being able to apply it and walk through, level by level. So that tells us that NVIDIA, as long as it's still sitting inside the 50% of last week, and the midpoint is, well, let's just call it 177. If we close above that, then we have a chance next week to break above this week's high and get up into that 195 area. Bringing all that down into a daily, now it's kind of sloppy, choppy, violent. Got a lot of drawings at this point, a lot of noise. This big bar is the bar of concern for the overhead. So if we're going to try to get a breakout and run, we got to get above that 188. But we're inside of yesterday's range. It's not IX10 because, well, I guess we could call it IX10, but I don't like how that red bar closed below that bar. That kind of broke the IX10. But we are inside day. This is our range, even with that candle's close down there. This is our range that we got to get out of. And it's not good that we're closing in the bottom part of this range. We should be closing at least near the mid or above. And I don't like that we didn't do that, but it hasn't broken down yet. Hey, Owen, have a great weekend, buddy. Yep. I really love that. I love hearing about it from other people and how they get to use it. I just love it. I really got to get a book. I I know I talk to people from time to time who don't really know me, and they're like, "Wait, you do what?" Then it's my system, so they're like, "Well, I'm gonna just Google it. I'll hear about it later." I'm like, "Good luck Googling it, man. I made it. You're not gonna find it anywhere out there." You just said it too, and that's perfect. Working it out. Everybody that I've met that really starts to embrace this, they start adding their own little nuanced pieces to it that make it more personal to them. And you'll be amazed at how far you grow your way to match you, and it'll be yours after a while because it grows on you, and you're gonna be able to adapt it as you go. It's a really good system though. I like it. I keep trying to find ways to improve it. And I don't know. I think I've gotten better at explaining it, but I don't think I've really found many ways to improve it beyond its original conception. Yeah, that is always a really good one. And when it's someone who's never seen that before and I do that, I love to see their reaction. They're just like, "Wait, what did you just do?" I did have someone say, "Why the hell does it work?" And I wish I had a really good why, but I don't. I just know that it works. I don't have a why. The good thing is though that other than penny stocks, I have yet to try it there, so I can't say that it does. It works for equities and futures, commodities, ETFs. It does pretty good. Pennies, I'm not sure. I think with penny stocks, you'd probably have to use a half and a whole and not use the 111 and the 1236. But the half should still work and the 786 should still work. But penny stocks are event driven, and that means their breakouts are going to be so violent that it probably would rip right through 111 and 1236. Speaking of penny stocks, um, I was looking at Seeking Alpha, their top rated stocks, because I was going to adjust the settings on this thing. And one of their stocks really had my attention. Let's see if I can find it again. If not, I kept a link. EGAN. This is the summary that it gave. Let's see if I can pop that up. If I do it right. Search on the internet. Nope, that wasn't it. So EGAN, it was in this list, and it is a stock I don't normally mess with because, of course, I'm really picky about liquidity. And they were talking it up really good. Like it has a lot of rating summaries that are all green and it's in a buy mode for everything except growth, which is a little weak. So at first glance, you look at it and you're like, heck yeah, this is fantastic. It's in the right space. It's really bullish. It's got all of these quant ratings that are everybody's interested in it. Rah, rah, rah. And then you go look at the stock. And I'm not picking on Spot Gamma or Seeking Alpha here at all. It's not me saying that this is a bad service or a bad call or anything like that. Just how we can't only use quant ratings or how we can't only use analyst recommendations. They are not mentioning in any way that this is something you should be cautious of. They're all bye bye, rah rah. But look, when we snap a fib with my halfback, how it's digesting that halfback right now from this broad one, right? From 16 down to like four and a quarter, four and a half. That big run has this halfback, and that's really dangerous. We're right there on the make or break line. It's okay that we overshot because it's not perfect. We don't have to just land and bounce and run. So we overshot, we're digesting it, but that digestion is the key to the whole damn thing. And if this doesn't hold and we break, well, we're going to the lower levels, right? That's it. It's done. And if we don't break it and we come back out, then we still got the halfback of the move that we made after earnings. We got to get through that. So there's a lot of problems here, right, with this stock. And I was looking at their system thinking, wow, guys, you know, you should at least warn your community that that we got some issues. I'm on a monthly now, and we can see how the tops have been just horrible tops. And there's an old market phrase that says if 10 then 20. It's a real deal. All right, we're talking about doubling a stock price from $10 to $20. And this has made that trip 5 times now, 4 times, and for 4 different times it's been rejected and it has not made it to 20. So 20 is on the books at some point. If it doesn't crash and burn, it will eventually get to 20. And then once we actually close above 20 a few times, then it's going to be if 20, then 40. But right now, it's still, well, if 10, then 20. You know where we're at right now? 10. And it's not to the penny perfect, but if 10 fails, we're going back to 5. So we really need to digest this at 10 and then check that mid to get back up to previous highs. And I'm a believer in, if 10 then 20. I am, but this is dangerous at the moment. Do you see that TRB, by the way? It's so beautiful, and it went right back up to what it owes us. Candle body top. It missed it by just like tiny little bit, but it almost got it. Just like it should. Look at that. It's so close. Missed it by 16 pennies. That's so awesome. The system works everywhere. So I like this one, EGAN. There is some issues with the company. That's why they sold off on the last earnings. They have a very narrow moat and big competition, right? So they're losing ground to some other names. Their peers are eating their lunch, so to speak. Let me put this summary in. Hopefully, we can still read it. This analyst report. It was an AI generated analyst report on EGAN. Has the company description, what it does, who its peers are: Salesforce, Microsoft, Oracle. Those are big names to be fighting against. David and Goliath kind of thing. Keep scrolling down, and we get into the positives and then the concerns. Well, the concerns are the right now they've got 3 or 4 really big clients, and those 3 or 4 really big clients are the only thing keeping these guys alive. All it's going to take is losing one of those big clients and they're toast. I don't know if I like that or not, but if I can find a way into this trade and keep the risk down, I'm probably going to end up doing it. It's just, it needs to have options so that when we trade the stock, we can defend that stock with options. And I want to know that we've got a path forward that they're working on trying to expand the client base and not outspend, because they can't outspend, right? Those guys that they're competing against have way more money than they do. You're not going to outspend Microsoft. I don't care what company you are. Maybe Nvidia, I guess, one of the big dogs, but this isn't one of the big dogs. So if they try to compete with spending on those guys, all they're going to do is blow all their money, and then they're not going to have any money. And one thing breaks when you don't have money, and you're toast. If they have to do a stock offering and dilute the shares, they're broke. You see, there's a lot of like really risky things that can go wrong here, but it's on the make or break line right now, and it's worth keeping an eye on, because if we can get that breakout, it's going to be really nice. I don't like buying on a breakout. I'd rather buy it when it's down here somewhere around 10, maybe a little under 10. So, I want to buy low, sell high kind of thing. As generic as that sounds, that's what I'd rather do. But if you do want to wait for the breakout, let it close above the box so that you're more confident in the move back. Like turn on the 786, I guess would be a good way to say it. Yeah, that's about the top of the box. I did that well enough. Get through the 786 and you got to run back to the mid. And that would, of course, give us a chance to try to close that earnings gap. Yep, yep. Otherwise, hey, it's a nice short. If we can break the low, then we get into 111 and the 1236. That would get us down here somewhere. And then we can work our way back to $5. It had a really interesting topping pattern too while it was up there digesting all that. So I don't know. I like how we can look around and apply this technique to all kinds of things, and it still works. Which is why I guess when I was in FX Street. I was in that Discord when this guy was in there just like, "What are we buying? Blah blah blah." He just wanted to spend money, but it just seemed like he was begging to lose money. And I tried to counsel him a little and get him to calm down and realize there's a lot of risk right now, but he wasn't buying what I had to say. He just wanted to find something to trade. We can trade anything 24 hours a day. I promise there's always a trade out there. But maybe we shouldn't be trying to find every trade we can find every minute of the day. So the topic for today, the last thing that was on the list is, should we try to increase our sample size to let their edge work, or should they decrease their sample size to focus on the highest quality trades, highest quality setups? Now, we all got responsibilities. I got to put food on the table. I got to keep the lights on. I got bills to pay. I have to get a trade. If I get too picky and I sit around waiting for the perfect trade, then I don't get any trade at all, or I'm not getting enough, and then I can't meet my obligations. So we always have to try to gauge the risk we're willing to take. And we're all human too. I get kind of bored just sitting around. I've got video games I'll play. I've got books that I read. I mean, I stay busy, but I'm as I'm as human as anybody else. And it gets to the point where I'm like, I will start trading things I probably shouldn't trade, or things that are lower quality. But as long as even a lower quality trade can still be gauged against risk. So I don't have a perfect answer to that, except that if you can and when you can, you should try to take the higher quality trade. It's quality, not quantity. I promise you that. It's quality, not quantity. If I take sorry setups or sloppy setups or trades that they're just not good, it degrades my confidence in my strategy, because then my strategy is not as effective, my win rate is not as good, my profits aren't as good, and I start thinking, what am I doing wrong? Am I doing something wrong? What this isn't working so good. It's the same setup, it's the same strategy. It's just in a higher risk environment, or a it didn't have such a decent setup and I did it anyways, and then the outcome suffers. Everything, my confidence, my profits, everything suffers. So I would rather take the better setup. But I gave up on perfect a long time ago. Doesn't have to be perfect, but it should be a real setup, not something we invented just to find the opportunity to get another trade. Because that's an easy thing to fall down a rabbit hole, and then we're just trading trash. So hopefully we got somewhere today. I'm going to try to find that spreadsheet where I built a calculator that tells you what your win rate needs to be depending on your risk to reward. But until I find it, you can always just ask AI. Tell the AI what your risk to reward is and ask it what win rate you need to sustain or survive, and it'll tell you. And then that's your starting point, right? I have, yeah. There's a couple of journal companies over the years that I tried to work with, and Thinkorswim is not necessarily broker when it comes to showing us what our trade records are. So for those places, what they would say is, well, download your CRV or CSV from your broker. So it's been a while, but let's see if I can get it done. Export to file from my trade and activities position. And if I do that, it should be a CSV file, no page to export, because I don't trade on Thinkorswim. So it's saying we don't have anything to do. But that would be where you get it. Tradeovate and those guys, I think those are a PDF document instead of a SRV file. But whatever your broker will offer you for the download, what it's basically doing is I've had people tell me that their journal is the entry, the exit, and the money made or lost. Well, that's not a journal. That's a trade record, and your broker carries those records. You can download them, whether it's a PDF or an SRV file. It's still a document that you can download that has all of your trades on it. And then you can tell it how many trades to download, just today's, last week's, all trades since you've had the account. You can download them and then you can upload them either to Grok or to one of these online journal sites, and you can get your stats out of it. Things like trade win rate, your average P&L, your average loss size. It can answer a lot of questions for you, but it's not a perfect system because what if you were uh, um, on paper the whole time and you downloaded a paper account? You might have been running drills, which are not trades, and that can screw up your win rate, your P&L, all kinds of records. Or if you were, just screwing around testing a new strategy and then you download the records and it's not paying attention to, did these stats come from a particular trade setup or did these stats come from every single trade that I traded that day? Sorry, I was reading when you were talking. Try that again. No, say I want to improve my trading and I want to be very specific about one particular part of my trading. I want better entries. I want better exits. I want to hold longer or get out sooner or something, right? We want to take our trade and not the whole trade, but just one piece of the trade and say, I want to work on this one piece right here. That would be something that we could run in a drill. So if I wanted to improve my entries, I could develop a new entry technique and then trade only entries, like screw getting out, we'll just exit whenever we want, but we would only be getting in or focusing on getting into a trade over and over and over and over and over and over and over. It'd be like standing on the free throw line throwing the ball at the basket over and over and over. It won't make me a good basketball player, but I'll get really good at shooting from the keys, right? So drills help us focus on one single aspect of a particular thing, like trades, entries, exits, targets, any particular part of the trade that we want to work on. I have clients where a lot of the drills we work on is small stop drills. Small stop drills are frustrating. They'll make you pull your hair out, but it'll get you a lot better at using a tighter stop, which is awesome, because I mean, anything you can do to use a smaller stop is a good thing. You can do it on anything. The idea is we want to do a lot of them. So we need to change our time frames. I don't trade a 10-second chart or a 15-second, 30-second. But if I want to do drills, I'd like to get 5 drills about every 2 or 3 minutes. I want a lot. So the trick to getting a lot of entries, a lot of exits, a lot of whatever it is I'm trying to do is to go to a smaller time frame so that we have more opportunities to do it, so that we can do a lot of them. So, they're definitely not trades, but they are trade mechanics. And the goal would be go to a smaller time frame and then execute your drill on that. I ran I think I've got a video somewhere. I built a drill called the twofer, and the twofer is a two tick stop. It's a stop drill that I was talking about, and we use it on the Nasdaq, no less. But yeah, it'll make you pull your hair out, really. There's a question about the fibs. Joe, there is no book or video or anything that I've ever found outside of the Bullish Bears that ever mentions dynamic fib placement because I invented it. Now, I'm sure somewhere in the world somebody else was already doing it and maybe they have wrote something, but one, I honestly I've never looked because, a little egotistical, I guess, but since I thought of it myself, I didn't think to look if anybody else has. I'm sure somebody in the world has, maybe. But the style that we use around here is the one that I built. So I would love to point you towards books or videos on it, but the only thing you'll find is the stuff that we've made. I've done videos, afternoon streams and that sort of thing, and have put them in the replays. So I would say start here, scroll back through the replays, or run a search in the upper right corner for anything that talks about fibs or fib placement and dynamic fibs, anything like that, because I made it. Nice. I love that. Everybody, I hope you have a good weekend. Always love the Q&A. If you guys got topics you want to cover or anything like that, please hit me up. Yeah, all of us at the Bullish Bears, we love the feedback. Always nice to have topics to cover. So I'm not the only one that takes topic requests, by the way. And yeah, keep them coming. Anything we can do to help get you where you need to be, that's what we're here for. I'm gonna find a video that I made called the twofer. It might be on the Bullish Bears website because I think I put drills on the Bullish Bears as well. So make sure you swing by the Bullish Bears and check the next level trading library to see if I put the trading drills there. At least one, because there's so many drills. Like there's a million drills. And I'm fairly confident that I put drills, at least the twofer, on the Bullish Bears. I'm pretty confident about that. Yeah, but I think I used the number two FER twofer, like just a little slang. I'll write it in the chat. Yep. That'll work. Two for live should be it, and two for drill. Yeah, it should. Well, I typed in drills. I didn't get anything. So I'm on the Bullish Bears. I typed in twofer and it showed two for trading drill right there, and then two for live right there, and two for live there. So that those are the ones you want. Ah, yeah, that is one of the other videos that I made. Yep, the cut and reverse. Well, the cut and reverse is a it's not even about trading, it's more about reading the market, and it's about understanding that the idea of how we trade. If we can identify the reversal is only a small reversal, then we're more likely to stay in and just let the little reversal happen because we've got our eye on the bigger picture. The drill is a self-reflection technique that gets us to realize, that we're looking too close, or we're looking too far away. And yeah, it's a good drill, but it's 100% not about why did I get out and sit on my hands? I should have just reversed and ran it back the other way. It's no, it's not that. It's more of a reflection of our price reading